Would you like to discover the investment secrets that transformed Warren Buffett into a financial icon and unlock the potential for extraordinary investment returns? Today, we're cracking open The Warren Buffett Way by Robert Hagstrom, the book that promises to reveal the secrets of one of the most enigmatic financial geniuses of our time. Warren Buffett, who began with an investment of $100, built a business empire worth $752 billion. And in this book summary, we will focus on what shaped Buffett's investing style. And most importantly, we will talk about Buffett's buying guide and his checklist of what he looks for when determining whether he is willing to invest. Let's dive in. A promising start. The world's greatest investor was not an ordinary child by any means. At just 11 years old, young Buffett purchased his first stocks. His initial capital, well, he used the money he'd earned by selling sticks of gum and Coca-Cola door to door in his neighborhood. After he graduated college, Buffett fought for a position at Graham-Newman Corporation to work with his mentor, Benjamin Graham, where he got his real education in trading. Benjamin Graham is renowned for his works Security Analysis and The Intelligent Investor, a book that changed Buffett's life, according to the billionaire. Graham's investment philosophy revolved around a single, straightforward principle: avoid losses. He applied his meticulous research and attention to detail to pinpoint two critical aspects of sound investments. First, he sought out companies trading at less than 2/3 of their intrinsic value. Second, he insisted on stocks with a low price-to-earnings ratio. Buffett adopted this methodology as his guiding light. At the age of 25, Buffett started his first limited liability partnership with a $100 investment. His goal? He wanted to beat the Dow Jones by 10% a year. He overshot and ended up beating it by 22%. And over a 12-year period, he grew his initial investment to $25 million. Another figure of great influence in Buffett's educational journey was Philip Fisher. Fisher delved deeply into researching the intricacies of identifying good investments. His philosophy diverged significantly from Graham's because instead of prioritizing bargain purchases, Fisher placed his faith in acquiring high-quality assets. One of the ways Fisher influenced Buffett was through his long-standing friend and unofficial investment partner, Charlie Munger, who created a partnership similar to the one Buffett started and reaped similar rewards. He bought blue-chip stamps, which later merged with Berkshire Hathaway, at which point Charlie became vice chairman. Buffett hesitated to depart from his well-established Graham investment methods, but he eventually yielded to persuasion. Fast forward a few decades later, and his company, Berkshire Hathaway, is worth over $750 billion. Now that you know what shaped his investing philosophy, let's dive into how Warren Buffett decides what business to buy. Buying a business, the 12 immutable tenets. In Chapter 3 of The Warren Buffett Way, the author presents the 12 investment tenets practiced by Warren Buffett. These tenets serve as guiding principles for Buffett's investment philosophy and provide valuable insights for investors. 1. Business, not stocks. Warren Buffett's investment philosophy transcends the superficial world of stocks. He views stocks as a direct representation of businesses and their underlying assets, rather than mere pieces of paper to be traded. For Buffett, the key to successful investing lies in understanding the fundamental nature of the business, its competitive advantages, and its long-term prospects. By delving into the intricacies of each business he considers, he seeks to uncover the core factors that will drive its success over the years. In his eyes, the purchase of a stock signifies ownership in a real, tangible enterprise, with a share in its profits and future growth. This perspective guides him towards businesses that he can truly grasp, rather than those with elusive or complex operations. By focusing on the business itself, he strives to make investment decisions that are grounded in sound reasoning, contributing to his remarkable success in the world of finance. Long-term prospects. Warren Buffett's strategy is firmly rooted in the pursuit of enduring competitive advantages, which he affectionately terms economic moats. These moats are the protective fortifications that safeguard a business against competition and ensure its sustained profitability. Buffett is not interested in businesses with short-term flashes of success, but rather in those with robust, long-term prospects. By investing in businesses with economic moats, Buffett aligns himself with companies that have constructed barriers against the erosive forces of the market. These barriers come in various forms, such as strong brand recognition, network effects, cost advantages, and intangible assets like patents. Buffett's approach is akin to owning a castle with impenetrable walls that can withstand the test of time. He looks for businesses that can continue to thrive and generate profits for years, if not decades, to come. This emphasis on long-term prospects rather than quick gains is a hallmark of his investment philosophy and has led to his enduring success as an investor. Management competence. Warren Buffett places unwavering trust in the competence and integrity of a company's leadership. He believes that a capable and honest management team is an essential ingredient for success. When evaluating potential investments, he looks for companies run by individuals with a proven track record of success. These leaders not only possess the skills required to guide the company, but also adhere to shareholder-friendly policies. They prioritize the best interests of the company's owners, thereby fostering a culture of transparency and trust. Buffett's insistence on management competence stems from his belief that even the most promising business can falter without skilled leadership. He is keenly aware of the impact that decisions made by company executives can have on the company's performance and shareholder value. By aligning his investments with companies led by competent and ethical managers, he seeks to minimize risks and enhance the potential for long-term success. Margin of safety. One of Warren Buffett's fundamental principles is the concept of a margin of safety. He emphasizes the importance of purchasing stocks at prices significantly below their intrinsic value. This margin of safety acts as a financial buffer, guarding against potential losses and providing room for growth. It offers a cushion that can absorb unexpected market volatility and unforeseen challenges, ensuring that investments remain resilient even in challenging times. Buffett's focus on a margin of safety is a testament to his prudent and cautious approach to investing. Rather than being enticed by the lure of quick gains, he is willing to exercise patience and discipline in order to protect his investments from undue risks. By acquiring stocks at prices that are below their true worth, he enhances the likelihood of favorable outcomes and the preservation of capital, qualities that are essential to his sustained success in the world of finance. Market price is not intrinsic value. Warren Buffett's approach to investing involves a critical distinction between market price and intrinsic value. He firmly believes that the market price of a stock often does not accurately reflect its intrinsic value. While many investors may be swayed by the daily fluctuations in stock prices, Buffett remains unwavering in his commitment to assessing a stock's true worth based on thorough analysis and diligent research. This differentiation is at the heart of his investment strategy. Buffett's decisions are not guided by short-term market sentiment, but by a profound understanding of a company's underlying fundamentals and potential for long-term success. His focus on intrinsic value enables him to identify opportunities that others may overlook, giving him a unique advantage in the world of investing. Intrinsic value calculation. Warren Buffett's investment approach centers on the meticulous calculation of intrinsic value. He employs an array of financial tools and analytical techniques to estimate the intrinsic value of a company. This intricate process entails forecasting a company's future cash flows and discounting them to their present value. By performing these calculations, he arrives at a figure that represents his assessment of the company's true worth. This emphasis on intrinsic value is a key aspect of Buffett's investment philosophy. It allows him to make informed decisions based on a thorough understanding of a company's financial health and potential for growth. It also acts as a counterbalance to the often irrational behavior of financial markets, guiding him toward opportunities that align with his long-term vision for investment success. Conservative financing. Warren Buffett values companies with conservative financial practices. This principle involves businesses using debt judiciously and maintaining a strong balance sheet. By opting for conservative financing, companies minimize the risk of financial distress, ensuring that they are well positioned to weather economic downturns and challenging market conditions. For Buffett, conservative financing is a safeguard against potential pitfalls. It signifies that a company is prudently managing its capital structure, making sensible decisions about leverage, and safeguarding the interests of shareholders. This approach aligns with his overarching goal of preserving and growing the capital entrusted to him through wise and thoughtful investment choices. Stable and understandable business. Simplicity and stability are qualities that Warren Buffett values in businesses. He is inclined to invest in companies with straightforward and predictable operations. He steers clear of businesses with complicated or erratic business models that may be challenging to comprehend. By seeking stability and understandability, he aims to minimize the uncertainties associated with complex enterprises. Buffett's preference for stable and understandable businesses aligns with his long-term approach to investing. He believes that such companies are more likely to weather economic storms and continue to generate consistent profits. This preference also allows him to maintain a clear focus on the core elements of a business, helping to make well-informed investment decisions. Consistent earnings. Warren Buffett values a track record of consistent earnings in the businesses he considers for investment. Consistent earnings indicate that a company has a competitive advantage and a strong business model. This stability provides a dependable foundation upon which long-term investments can be built. For Buffett, businesses that demonstrate a history of delivering reliable earnings are more likely to weather economic downturns and market fluctuations. By seeking companies with consistent earnings, Buffett aligns his investments with enterprises that have proven their ability to generate profits over time. This track record enhances the predictability of future earnings, a quality that is highly prized in his investment philosophy. High return on equity. A high return on equity, ROE, is a sought-after characteristic in Warren Buffett's investment choices. ROE reflects a company's efficiency and profitability by measuring the return generated on shareholders' equity. High ROE is indicative of a company's adept use of its capital and assets, resulting in above-average profitability. For Buffett, a strong ROE is a sign of a well-managed business that can efficiently deploy its resources to create value for its owners. This emphasis on a high return on equity underscores his commitment to investing in companies that are not only profitable, but also capable of sustaining their profitability over time. Owner earnings. In Warren Buffett's investment strategy, the concept of owner earnings plays a pivotal role. Owner earnings represent a company's net income plus depreciation, depletion, and amortization, minus capital expenditures. This metric reflects the cash generated for the owner and provides a clearer picture of a company's true financial health. Buffett's focus on owner earnings is rooted in the belief that cash flow, rather than accounting profits, is the ultimate measure of a business's financial performance. By analyzing owner earnings, he gains insight into a company's ability to generate cash, which is vital for its growth, debt servicing, and the distribution of dividends. This focus on tangible cash flow aligns with his pragmatic and long-term approach to investing, allowing him to make decisions that are grounded in economic reality. Market timing. Warren Buffett is a vocal advocate for the importance of a long-term perspective in investing. He emphasizes that market timing is not a reliable strategy and cautions against trying to predict short-term market movements. Instead, he encourages investors to focus on the intrinsic qualities of businesses, exercise patience, and hold their investments over the long term. Buffett's approach rejects the notion of attempting to time the market, which often leads to unnecessary buying and selling of assets. He believes that a well-reasoned and patient investment strategy based on sound principles can yield more consistent and successful outcomes over the years. By shunning the allure of market timing, he underscores the significance of maintaining a steadfast commitment to a well-founded investment philosophy. These 12 tenets form the core of Warren Buffett's investment philosophy, and they provide a comprehensive framework for assessing potential investments and making informed decisions in the world of finance. Warren Buffett's main aim is to invest in strong, well-run companies that have a bright future and the potential for big profits. The author Robert Hagstrom also digs into other important things like behavioral finance and the value of patience in his book, as well as many real case studies with an extensive amount of financial analysis about Buffett's investments. We recommend this book to everyone who wants to be an active investor. If you want to learn a little more about behavioral finance, we recommend you watch our video of the key takeaways from the best-selling book, The Psychology of Money, by Morgan Housel. We hope you had a blast and learned a ton about the Oracle of Omaha's strategies. Remember, the road to financial success is a marathon, not a sprint. Thanks for tuning in, and don't forget to comment and give us a thumbs up.